In this video, we're going to be talking about the maximum amount of money you can get back on your taxes filing in 2025. But first, we're going to go ahead and hit that like and subscribe button so that we can keep putting out videos just like this for you in the future, and you can get notifications so you can get more money back in your pocket. So let's jump right into this video. So how can you get the most money back on taxes in 2025? Well, specifically, I want to talk about the differences between the tax deduction and the tax credit. Making sure that you maximize your deductions and maximizing your credits will make sure that you're going to be paying less to Uncle Sam and not more, so that you can get the money back to you that you are owed. So first, before we jump into that, I want to talk about what a tax deduction is compared to the tax credit. I'm going to start this off by asking a question. Would you rather have a $10,000 tax deduction or a $10,000 tax credit? Well, if you look at it one way, if you're looking at your AGI or your adjusted gross income, if it's $100,000 for both of these scenarios, and if your tax deduction of $10,000 reduces your taxable income down from $100,000 all the way down to $90,000, now what you need to do is look at your taxes and see how much you're going to be paying. If you're only going to be taxed on $90,000 at a 25% tax rate, then that bill will be about $22,500. Whereas if you compared that to a tax credit, a $10,000 tax credit with an income of $100,000 does not change the AGI. And that taxable income is still going to be taxed on that $100,000 income. So because there's no tax deductions, that amount of tax will be higher. Now, if you look at a 25% tax rate that will be calculated out off of that $100,000, that will be about $25,000. So if you were to go ahead and compare the original reduction from the deduction versus the income tax credit, then you'd be looking at a $22,500 tax bill compared to a $25,000 tax bill with the tax credit. But we didn't talk about what happens when you reduce that $10,000 for that tax credit. The $22,500 is still going to be way cheaper without applying that tax credit. But if you look at the $10,000 credit at the total taxable bill, and you take $25,000 and then subtract $10,000, your new tax bill is only going to be $15,000, which is way less than the $22,500 tax bill that you're getting from the tax deductions. So in the end, the tax credit is going to be much better than the tax deduction, but if you can start taking advantage of both tax credits and tax deductions, and you're getting all of your deductions and getting all of your credits, then it's going to end up leading to a better way for you to maximize your tax refund this year. And that's what this video is going to be focusing on. So hopefully this helped illustrated the point of knowing what you can claim for your deductions and knowing what you can claim for your credits, so that it will be a little bit less confusing. But we're going to go in a little bit more detail in this video and break it down so that you can take care of it this year. So a tax deduction is going to be something that is going to be lowering your taxable income, and thus it will reduce your tax liability. So what you're going to want to do is this would then subtract the deduction amount from your actual total income, and this would be called the adjusted gross income, or your AGI. Therefore, the adjusted gross income is lower than the normal income that you're going to be reporting on your taxes, meaning that they're going to be calculating your taxes on the lower income, leading to a lower tax bill. So when we kind of break it down that way, it makes it a lot easier to understand that you're still going to be making the same amount of money. We're just going to be lowering what the government will be wanting you to pay your taxes on. So how do you claim these tax deductions, and where can you find them? Well, if you're going to be going online and you're going to be e-filing, then most of the time the software should be catching most of these deductions. But we want to make sure that you don't miss out on any of them and that you know what you're going to be doing, so that if something pops up, you can always double check that. So there are two types of taxes and deductions, and knowing the difference between these deductions will help you pick which one is best for you. It's very important because sometimes it can be a drastic amount of money. The first one is going to be a standardized tax deduction, and it is going to be the easiest to claim, and it is a preset value, and it's going to depend on your marital status. If you're filing single, then that deduction will be $14,600, and if you're filing married and jointly, it will be $29,200. So basically, if you have not kept track of your specific deductions over the past year, then the best deduction is going to be the standardized deduction in your case. But if you have kept up with that, then you could consider the itemized deduction, which we'll talk about in a little bit more. Now, the itemized deduction and how do you know if you should be doing the itemized deduction versus the standardized deduction really comes down to how much you can itemize out and if it's going to be greater than that standardized deduction. An itemized deduction is basically going to let you change your taxable income by taking away the tax burden by how much you have given away or how much you have paid in taxes and interest and other things similar to these over the span of the year. So the question is, should you itemize or should you take that standardized deduction depending on your specific situation? No one can really tell you specifically what to do until you run the numbers and you find out which one is better. Basically, if you go with the standard deduction and that is less than the sum of your itemized deduction, then you should probably take the itemized deduction because that will lower your tax burden even more than the standard one. You will end up paying less taxes because your adjusted gross income is going to be less than the standard deduction. So where do you find all these tax deductions? How do you know if you meet all these criteria so you can double check that your tax software is actually giving you the best deduction? Well, I'm going to put some information down below that'll go over some of the most commonly used tax deductions and tax credits so you can look through those and make sure that and see if they actually do apply to your certain situation or not. You can see that there are a couple different spots listing a bunch of different tax deductions and a bunch of different tax credits to make sure that you're filing online via the online software and TurboTax or whatever you're using is going to catch those. I really do make sure that you double check that because if you miss a tax credit, that's a significant amount of money that will be back in your pocket. So make sure that you're looking at that so that you can make sure that you get the highest tax refund this year. So I do have a couple tax deductions and credits that I want to talk about that are the most commonly used. Again, it is going to be down the link below, but these are the ones that are most common and I want to just hit on them really quickly. The child tax credit is going to be one of the big ones. That's one that was in the news and everybody was talking about. Basically for this year, per child, you can get up to $2,000 money back, and this is a credit. So it's going to reduce that overall final tax bill by that amount per child. In addition to this, there is a child independent care tax credit. There's also an American Opportunity Tax Credit, which a lot of the people will be using, ones that specifically people that are going to be putting this towards tuitions, books, equipment, and school fees. And a lot of people will be using the student loan interest deduction. This will allow you to deduct up to $2,500 for your student loans. And another big one is going to be the Earned Income Tax Credit. So specifically for 2024, the Earned Income Tax Credit is worth up to $7,830. That's pretty big. For eligible families with 3 or more children, so as long as you meet that particular criteria, you can file and you can get that amount of money. Now, this did change from last year. It went up from the $7,430, so an extra $400 from 2023 is pretty nice. So there is one going to be for the eligible workers aged 25 to 64 without dependents, and they can claim between $632 for 2024. Another really big one that many people will be able to add to their itemized deduction because they are giving charitable deductions. They're going to be able to deduct what they give to charities or they give to other places like that from their deductions, and that will add into their itemized deduction. If you donate some clothes to Goodwill, or if you just gave money to your church, or if you give money to charity, this may affect your itemized deduction for this year. If you gave enough money where it is going to be exceeding the amount of the standardized deduction, in addition to all the other itemizations that I talked about before, then this might actually help you out. Pretty much everyone will be able to use this next one, and you can deduct what you pay for your state and your local taxes. So basically, you can get up to $10,000 off when you're filing jointly on your property taxes, whether that's state or local income or sales tax. It can all be added up and tacked onto your itemized deduction. So don't forget that if you own a house, then you can deduct that as mortgage interest as well. That's quite a bit. Mortgage interest and PMI, all that adds into the itemized deduction, and it could potentially be greater than that standardized deduction. So aside from that, contributions to your IRAs are also tax deducted as well. So make sure that you're making your IRA max deduction every single year, and typically this will increase amount on an annual basis. So make sure that every year you're looking at what the maximum amount is, so that you can make sure that you are getting the max amount of money into your IRA, not only for your long-term savings, but also for your tax savings as well. All right, one of the bigger ones that I did want to talk about is going to be the Saver's Credit. It is a non-refundable tax credit available to mid and low income taxpayers who contribute to a retirement account. In 2024 tax year, the Saver's Credit phases out at $76,500 for married couples filing jointly, and $57,000 and $57,375 for head of households, and $38,250 for single and married individuals filing separately. Big mouthful for that one. But to qualify for these, individuals must have an adjusted gross income of up to $38,250 in 2024. So this tax credit, it's based off the 10%, the 20%, the 50% of the first $2,000 contributed to retirement accounts. And this can all be calculated and placed on the Form 8880 to calculate your tax credit, or the online tax software will take care of it. Again, a lot of big words, a lot of big numbers. All this will be added down in the description down below, so that you can double check these deductions and credits and make sure that you're following along, so that you can make sure that you're going to be online. E-filing system is going to be giving you the tax credits and all the deductions that you should be getting this year. So if you got some good information from this video, hit that like and subscribe button. We will be putting a video out more, talking about more tax refund tips, as well as ways that you can get some more money in your pocket. And as always, we remind you that we are here from your first penny to your first million. We'll see you next time.